of some of the ideas that we learn here. All right. Learning all of this is not going to make you an accountant, right? You can't say, oh, now that I've gotten this lesson, I can apply for an accounting position, but it will give you the skills you need to start, hopefully, running your company by the numbers. All right, so that just he really holds your hand and walks you through the income statement in that video. If you watched that last video that I embedded in the slide, you saw some of this stuff, but I'm going to go through it again. This is the basic structure of an income statement. It's got all of the basic categories of things in the order that you need to include in the income statement. So I'm going to walk you through this, but first of all, I want to point out three things. First of all, you see at the top, sales revenue minus cost of goods sold is gross profit. You need to understand that gross profit is not the end goal of an income statement. It's kind of up at the top, and we're going to subtract some other things for it. It's in general going to be a much bigger number than the other two that I want you to know. The second one that I want you to know is operating income. That's gross profit after you subtract out some operating expenses. So like the cost to keep the doors open, the marketing expenses, to pay the person that works at the front desk. All of those things are operating expenses that don't vary with how much you produce. And so subtract those from gross profit and there's operating income. All right, now we're going to add and subtract some other things like interest, things like tax, things like depreciation, and we're going to come up with net income or loss down at the bottom. All right, so this is the basic structure. All income statements need to be structured like this. Our gross profit is going to be the biggest, usually, followed by operating income, and then our net income or loss will be the smallest because we've got to subtract all those other things out. Right, so sales minus cost of goods sold equals gross profit minus operating expenses equal operating profit minus any interest expenses is going to equal the profits before tax, and then you want to subtract out your income tax, and then that's your net profit. Let's talk about cost of goods sold just for a minute. This is the cost of the production process, okay? What you use to create your product or service directly. All right, so cost of goods sold is going to include all of the inputs into your business. If I am making, if I'm selling lawnmowers, if I'm building and selling lawnmowers, it's all the parts that I put together that I have to buy to put that together and build a lawnmower. It's also the direct labor of the people that work on the lawnmower, right? So those are all direct expenses. Basically, the more I make, the more I pay out with those cost of goods sold, all right? I talked about operating expenses. A lot of things can fit there, but basically, those are the monthly expenses that are, it doesn't matter how much or how little of a product that you sell. Basically, those numbers are going to stay about the same each month. They can vary a little bit, but they're not really variable costs. They're fixed costs that you pay on a regular basis. Okay, there's a place on here for non-operating revenue or expense. And so there may be some kind of investment you have, some kind of sideline that you have that isn't directly part of producing the good or service that is focal to your business. And that would be those expenses that are there. So maybe, you have a farm and you rent out a piece of land to another farmer. You might put that in sales revenue, but if you're trying to keep up with like all your crop revenue separate, you might call that non-operating revenue or expense. Next is the interest expense. You want to subtract that out. Why do you subtract that out? Because you don't have to pay taxes on interest that you pay. And so you subtract that out and then you get your earnings before tax. All right. And then finally, you subtract out your income tax before you get the grand total that you go home with. I will say that, this number is obviously going to vary depending on how much you make. The more you make, the bigger chunk Uncle Sam is going to take. And if you make a loss, you will not have to pay any income tax, right? So if that earnings before EBT, if that earnings before tax, that EBT number is negative, then the income tax number will of course be 0. And this is just the example of an income statement. This is the Teddy Fab Inc. Statement of income. And the year ending December 31st, 2100. So we're looking at the future. Cost of goods sold is $200,000, so we subtract that from our revenue. So basically, Teddy Fab brought in $1 million. The cost of the company's goods sold were $200,000. So the gross profit looks pretty nice. It's $800,000. Unfortunately, we've still got to subtract some other things. All right, so there's selling expenses, general expenses, administrative expenses. That's $357,700. There's an interest expense that they are including here. We could do that after we calculate the operating income, but it's okay to go ahead and subtract that out now because the net income numbers are going to be the same. And then our depreciation and amortization expense. That is the idea that, like, if I put a new roof on my building or if I buy a new piece of equipment, that asset is going to depreciate over time because it's going to wear out. So the life expectancy may be 10 years, 15 years, 30 years, but at some point I'm going to have to replace it. And what best accounting practices say is to go ahead each year and subtract out the value that you lose on that, save that amount, and then at the end of the time period, you're going to be able to replace what it is that ran down. Okay, so that's what that depreciation is. And that ends, subtract all those things out, and you end with an operating income of $417,100. All right, and then they report an interest income, so some kind of investment that's earning interest of $20,000. So that actually increases the bottom line to $437,100. And then I have an income tax expense. All right, so my net income is $437,100. My income tax expense here is $240,000, which is a lot of income. That's a lot of income tax, but I guess because it's $2,100, there's kind of some pessimism that taxes will go up to pay for, I guess, the debt that we're spending now. Eventually, we're going to have to pay for that. So high tax rate in $2,100. Some of you guys may live to see that. I don't know if you'll still be in business in $2,100. That's a long time. And the net income is $197,100. You're going to be pretty old, right? Like 100 years old or a little more. So that's the net income. It gives you that grand total at the bottom of the screen. So the cash flow statement keeps up with how much money you have in your business. Now, when we talk about cash, we aren't necessarily talking about like a suitcase full of money or even a cash register full of money. We're not talking about tangible, physical, paper, and metal money, right? We're talking about what you have in your bank account. And so you're actually very familiar with cash flow statements if you monitor your bank account, and you should monitor your bank account. Monitoring cash flow is very similar to the bank statement that you receive. You never want to be overdrawn, right? So it's a pretty easy concept. The difficulty is just in all the details of keeping up with it, because for businesses, you make dozens of transactions in a day, all right? So this is a statement that covers a period of time and chronicles every transaction that the business makes. It changes multiple times per day. And what most cash flow statements are going to do is they're not going to, because there are so many transactions, they're not going to itemize them all individually, but they're going to pool similar transactions together so that you can see, where your money's going in and out. So over, a 3-month period of time, you may have 12 categories of transactions, and you're filing the different cash flow transactions into each of those categories. Now, not only are there smaller categories, there are larger categories as well. And these are operations, investment, and finance. These are the 3 main parts of the business. Operations is just one part. Operations is where most of the cash flow transactions are going to take place. This is in the day in, day out running of your business. But you don't want to ignore the other things, right? Because they also influence the amount of cash on hand. So when you're keeping up with cash, you've got to factor those into the equation. So investment is things like investing in your building, in your land, in machines, It's usually a cash outflow. And there's also financing activities, things like paying the interest on loans from banks, repaying that interest. In the cash flow statement, we have to keep up with all of these things. One of the important things about the cash flow statement is that it categorizes all of your transactions into one of those activities. Right, so I may get a cash loan from the bank to do some things, and I would file that under finance, and that's really important to keep up with that. It's not something that's in day-to-day operations. What we want to know, though, is that our operations are generating, for the most part, neutral or positive cash flow. Now, this may be difficult in the beginning stages of a business, but over time, if we're seeing the operations pull down, even if I've got like a buffer from my financing activities because I got a loan or a line of credit from the bank, even if I'm seeing that, I want to keep up with operations separately, because if operations are trending downward, that's a huge problem. If operations are negative, it's a very big problem. So you can think of the cash flow statement as the wallet of the business, and it answers the question, can we pay our bills right now? The when is critical with cash flow. Basically, and I'll repeat this a little bit more in a minute, but there's the idea that a business can be profitable and still have a cash flow problem. And a business can have short-term cash flows fine, but long-term will not be profitable. And both of those things are important to understand. So how can a business be profitable and have a cash flow problem? Think about that, but for right now, let me just suggest that the answer to that lies in, a couple categories, but one category is accounts receivable. You may not be getting paid yet, right? You may be getting paid way in the future, and for that reason, you've got a cash problem. So why is cash important? Well, cash is what is known as a liquid asset, meaning it can be exchanged easily. So the difference between having cash in your wallet or cash in your bank account versus having hard fixed assets, like maybe something at your house you could go sell, a piece of machinery, inventory, or otherwise, is that cash is so much more easily exchangeable when you have a financial obligation. We have to maintain positive cash to be able to pay the bills, to keep the lights on. Liquidity is an important term, and it is a term used to denote whether or not a business is generating cash from its assets or it's able to convert its assets into cash very quickly. All right, businesses want liquidity. You've heard the term cash is king. Liquidity is a measure of cash. A business may have a lot of factories and produce a lot of product, and they may be shipping their product to their customers, but if the customer never pays or is a long-term time in paying, the business can't stay afloat in the meantime. A lot of investors look at the cash flow statement before looking at anything else. It is the number one thing when they look at before they decide to go further. And that's because they want to know, is this business generating enough cash to meet its regular obligations? Cash flow is not profit. Again, that is something completely different that has to do with our income. There are businesses that are profitable that do not have adequate cash flow. There may also be businesses that have positive cash flow, at least in the short term, but they're not profitable. Of course, you cannot do that forever. All right. The cash flow equation is pretty easy. It's just net cash flow equals the beginning cash balance plus cash inflow minus cash outflows, right? So you can think of it as a water tank, right? You want to keep a substantial amount of water in the tank. Anytime, somebody gets a drink, turns on the faucet, that tank goes down. Those are your expenses. Anytime there is revenue going into the tank, that makes the tank level of water go up. You can't have a dry tank. The saying goes that cash is king, and we know that it's different than profit. So what I'd like you to do is imagine a company that sells something expensive. Let's think about a company that sells swimming pools each summer. And I've seen a lot of swimming pools going in this year. I think with kids and families being stuck at home, a lot of people decided to buy swimming pools. So swimming pools have had a good year. Swimming pools have to be really careful. Businesses have to be really careful about cash because they have to buy their inventory well before they get paid for it. All right, so a swimming pool company has to buy all of the equipment to install the pool itself, or whatever they use, the material that they use to make the pool. And that stuff's really expensive. And so maybe a family calls them in late April and says, can you guys come out and install this pool? And they're like, sure. And they spend a couple of weeks and they're out there, and they have it installed by the second or third week of May. Usually what will happen is they will send the customer a bill. Most customers won't pay for that entire pool. You can look them up. They're pretty expensive if you get an in-ground pool. They won't pay for it all up front. They will do it in installments. And so the company has sunk all of this money into building a pool up front, but they're not going to see the actual cash from that for a long time. Most of the income they've received so far is in the form of an account receivable, right? They've made the sale, the customer has pledged the money. On the income statement, it looks really nice. We've put in this pool and we're going to get paid for it, but they don't actually have the cash. So in the meantime, and a lot of families are putting in pools right at the beginning of the summer, right? It's very seasonal. So in the meantime, while the company's waiting to be paid, they've got to pay their workers. They've got to restock their inventory. They've got to keep their property going. They've got to eat themselves. Lots of things so they've got to pay themselves. Lots of things that they're going to need money for. But they haven't been paid by the customer. They haven't seen that cash yet. That's the issue with cash flow. That's why it's so important. So there's this whole deal with accounts receivable where we haven't gotten the money yet, and yet we need cash right now to pay for things. And so you have to budget for that and plan for that, and you have to know that, hey, we can survive June, July, August, etc., until enough of what we've done is paid back to keep us afloat, right? And so you can have a very profitable business that has a severe cash flow problem. Here are some concrete practical examples from your everyday experiences that help illustrate cash flow. For each of these, I want you to think, is there cash inflow, cash going into your bank account? Is there cash outflow, cash going out? Those are the two options. Or maybe there's both, or maybe there's neither. Okay? So for each of these, I am going to read them, pause the video and think about it, and then I'll tell you the answer. All right? The first one, you borrow $100 from a friend or family member, then you pay it back. Cash inflow, cash outflow, both or neither. It's actually both, right? When you borrow $100 from a friend or family member, that is cash inflow, all right? You may feel worse that now you owe money, and so you think that's a negative thing, but as terms of your cash flow statement goes, your cash went up, so that's cash inflow. Then you pay it back, that's cash outflow. You may feel relieved, and that's great, but your cash flow statement went down when you made that. Overall, it's a net of 0, right? The cash flow statement is the same at the same level before and after both these transactions, but both of these things do need to be recorded. So there's inflow and there's outflow. You record the transaction when it happens. When you borrowed the $100, there wasn't a 1,000% certainty guarantee that you would pay it back by such and such date. You did pay it back, and so you record it when you paid it back, but you don't record it before you pay it back, or you don't ignore it because you know you're going to pay it back. For that given time, there was an increase in cash. All right, number 2, you buy a $20,000 car. You use $5,000 of your own money as a down payment. What's going on here? Cash inflow? Cash outflow? Nothing? Both? What's going on here? All right, this is cash outflow. If we look at our bank statement, if we look at the amount of cash that we have after all of this, and that's all we look at, and that's all you should be looking at, we are $5,000 cash poorer, right? We spent $5,000 of our own money to make this car. Now, this car may be the car of our dreams. We may be extremely happy about that. That doesn't mean that our cash flow went up. What you may think, oh, I just paid $5,000 and I have this $20,000 asset, so I'm better off, even though I owe this money. Well, you have a lot more, in terms of hard assets, but your cash went down. So just because you have this car that is worth $20,000, your cash position wasn't improved by it. All right, and eventually you're going to pay. There's going to be more payments come out of your cash to pay off the rest of that car over time. All right, number 3, you take $1,000 in cash and buy 53 shares of Snap.com stock. Outflow, inflow, neither, both. What is it? It's outflow, right? Again, you may feel wonderful about your decision to buy this stock. You may think that you're going to be a millionaire one day because of these 53 shares. But in the near term right now, you are $1,000 poorer in terms of cash, and so that needs to be reflected on the cash flow statement. That doesn't say anything about whether any of these are good ideas or bad ideas. We just want to reflect them on the cash flow statement. All right. You get a paycheck, then you pay your cell phone bill. Inflow, outflow, neither, or both. It's both, right? The paycheck is inflow, the paying the bill is outflow. And we don't know the relative size of those. We can assume and hope that the paycheck is bigger than the cell phone bill, which would indicate that the net cash position after these two transactions went up, but that information is not given to us here. What we know is that there are 2 transactions, an inflow transaction and an outflow transaction. All right, number 5, you sign up a customer for new cable service and you send them a bill for $156. Inflow, outflow, neither, or both. This one's actually neither, okay? No cash has changed hands yet. You may be happy about what you did, right? You went and signed up this customer. Hooray, I'm $156 richer, but don't count your chickens before they're hatched in the cash flow statement. You can go ahead and record that on the income statement, that $156 in revenue. It's an account receivable, but you haven't seen the cash yet. The last thing I want to say about this slide is to please, it probably makes sense to take the time to watch that video at the bottom. He walks you through some hypothetical cash flow statements so you can really look at the numbers and see what's going on. I think you should do that so that you get experience looking at cash flow statements. You can watch more of the video, but I've actually borrowed quite heavily from that one in terms of what I've just said, so suit yourself. I would probably just watch, if I were you, that time segment, that 4 or 5 minutes that's listed there, 5+ minutes that's listed there. So here's just another example of a cash flow statement, and this is the cash flow statement summarized for all of the year 2008. So notice at the top you've got your cash at the beginning of the year, $15,700. That's the cash position that you start with. And then here's operations, cash coming in from operations, $693,200 of revenue. And then all of the outflow from operations. So you've got your inventory, your operating and administrative expenses, your wage expenses, your interest, and your income taxes. And that results in $147,900 positive cash flow from operations. Then we've got our next big category, our investing activities. Looks like we sold some property and equipment, so that's $33,600 coming in. And then some cash was paid for some new property and equipment, I guess maybe to take the place of the old. And we have a negative of $41,400 here. All right. And then here's our financing activities. Again, several categories here that we don't have anything for. We did pay $34,000 back in loans, so apparently we had a loan from the bank and we made monthly payments and the total amounted to $34,000, or it might have been quarterly payments or a one-time lump sum payment for the year of $34,000. And we also paid out, we had some investors in our company, so we paid out $53,000 in dividends. All right, so both of these are negative. Anytime you see something in parentheses, that means that that number is negative on an accounting statement. And so for investment, we had negative $41,400. Now down here for financing activities, we have negative $87,000. All right, in parentheses, it's negative. So we add up our positive $147,900, subtract $41,400 and $87,000 from that, and we get a net increase in cash. This isn't our cash position yet. This is our net increase in cash for the year of $19,500. Then we can calculate our total cash position, and that is done by adding up our cash at the beginning of the year, $15,700, with our net increase in cash, $19,500, for a grand total of $35,200 in cash at the end of 2008.